Okay, welcome everyone. Thanks for joining this Artemis Live webinar, held in association with our kind partner Artex Capital Solutions this time around. We've still got people filing into the room now, but we're going to kick things off. We've got an hour for this discussion today. Now, yes, as I said, kindly supported by Artex today, and Artex Capital Solutions is a facilitator in the insurance-linked securities and reinsurance market. They're a pioneer in the ILS and fund administration industry, and they create and manage many of the market's ILS and other structures that connect capital to risk. So today, with the help of these speakers we've got with us, we're going to dive into a fascinating topic, the use of capital market structures by originators of risk, such as managing general agents or MGAs. Now, the use of alternative sources of risk and reinsurance capital by the originators is a notable trend and one we anticipate expanding over time. And we're already seeing innovative use of ILS structures such as sidecars to provide an aligned mechanism through which investors can participate in the underwriting performance of risk originators such as MGAs, while those originators can benefit from access to an efficient and diversifying alternative capital source. So it's an aligned and strategic move that allows partnership with third-party capital through the use of sophisticated ILS markets to achieve that. It's the trend we're going to explore in the next hour with the help of this very experienced panel today. So I'm delighted to welcome Scott Cobon, Managing Director of Insurance Management Services at Artex Capital Solutions. We have Raul Lobo, Vice President at Stone Point Capital, Brad Adderley, Managing Director and the Bermuda Managing Partner at Appleby, and Ethan Allen, Executive Vice President, Chief Risk Officer at MS Transverse Insurance Group. Welcome all of you, and thanks very much for joining us today for this discussion.
Thanks for having us, Steve.
Yeah, thanks. Morning, Steve. Thank you.
So we've got a real good amount of experience and some specialist expertise with us today, and rather than introduce everybody in depth, I'm going to let their responses to the questions do the talking, and you'll learn more about them and their specialism in the space as we go. Got an hour to go, so let's kick things off and get right into it. And to start with, I want to set the scene a bit and ask our panelists to share some insights on their positions in the market value chain, as well as their broad thoughts on the opportunity that capital market structures presents in accessing alternative sources of reinsurance capacity. So, Scott Cobon from Artex, I'm going to begin with you. You're a facilitator of transactions, you help risk originators establish structures, you manage them, and you help them to access these new sources of capacity. So, perhaps you could explain Artex's role here, the services you provide, and also give us your broad thoughts on this opportunity for MGAs.
Yeah, certainly. Thanks, Steve. Here at Artex Capital Solutions, we're a facilitator linking risk to the financial markets. For close to 20 years, we've developed and facilitated many structures that are now the bedrock of the insurance-linked security industry. Our core strategy is to be able to provide investors turnkey solutions to access insurance market risk. This comes in many forms, but broadly, if I start at the investor level, we provide fund administration services to many of the insurance-linked security funds. We also provide insurance management services to a whole host of a variety of structures, including our own risk transformation entities. Amongst all of that, we also provide a lot of advisory type work, from client setup to the valuation of certain investor positions. One of these facilities that we manage, and you've mentioned it earlier, is a sidecar. Almost every reinsurer in the market today has a sidecar that allows it to access the financial market. What I'm excited to talk about today is what we're seeing in the market in terms of effectively overlaying this structure, this tried and tested structure on the world of MGAs and active fronting companies. Currently, according to the Program Administration Association, there's about 80 billion in premiums in this market, with 13% year-on-year growth. When you dig into these numbers, it's more interesting that a lot of this premium growth is coming from the property and E&S markets, especially in the southeast of the US. So Steve, yeah, we're super excited by the development of this market and help to facilitate it. And I'm sure the rest of this discussion will bring that to the surface.
Brilliant. Thank you, Scott. Ethan, going to move on to you now. Your business at MS Transverse fronts for a significant number of MGAs and you help them access reinsurance capital in all of its forms. Perhaps you could explain how you view the opportunity of accessing differentiated capital sources and how important that could be for the MGA community.
Yeah, thanks, Steve. This is such an important source of capital for the MGA space that we've made a significant investment at MS Transverse in terms of the people and the processes that back the multiple transactions we've already done and the dozens that we see coming over the next several months and years. And this increase in the interest of capital markets in supporting the MGA space, in part driven by what Scott mentioned, which is just the general growth of MGAs, their entrepreneurial nature, their specialization. But there's really 6 key components associated with these other sources of capital beyond what I would call traditional reinsurance that make it really interesting for an MGA partner. So first is there's enhanced flexibility. Differentiated capital sources will offer a wider range of risk appetites, investment horizons, and pricing models than traditional reinsurance markets typically rely on. This flexibility can allow MGAs to tailor their capital solutions to specific risk portfolio, potentially leading to more favorable terms. The second is an increase in capacity. By tapping into diverse capital pools, MGAs can secure additional capacity, enabling them to write more business and grow their operations. This is particularly valuable in hardening markets or when traditional reinsurance capacity finds itself constrained. The third area is diversification. By diversifying capital sources, it reduces the reliance on a single source and mitigates counterparty risk. This can enhance the overall stability and resilience of an MGA's business model. Fourth is the ability to provide innovative solutions. Some differentiated capital sources, such as ILS funds and collateralized reinsurance, may be more open to innovative risk transfer structures and parametric solutions. This can also provide MGAs with opportunities to develop unique products and services. Fifth is the potential for improved pricing terms and conditions that comes with increased competition. Having more competition between the capital providers can lead to more competitive pricing, terms, conditions, and that ultimately benefits the MGAs and their policyholders. Lastly is just the ability to build long-term partnerships. Most of these differentiated capital sources seek long-term partners, and this provides stability and predictability in the capital markets. So this increasing importance of being able to access differentiated capital cannot be overstated. It gives additional tools to help navigate evolving market dynamics, enhance risk management capabilities, and drive sustainable growth. And more alternative capital providers are looking for partners they can trust to help them partner with the best MGAs in the industry.
Great, thank you, Ethan. I'm glad you mentioned the long-term partnership there, because I think that's what makes this so exciting, is that this is a trend that we're going to see develop for some years to come. Now, moving to you, Brad, your firm Appleby work on a wide range of ILS structures, and can you provide some insights into what you've been seeing among risk originators such as MGAs and how they're looking to access sources of institutional capital and capacity?
Sure, Steve. Hello, everyone. I think in this day and age, we're seeing a lot more MGAs being formed, which I think is different from years ago, but in some ways it's the same. If you go back in time to the late 90s, for the people who are doing this like me, most of the new startups were monolines. They were specialty reinsurers. And to me, an MGA is a specialty group of underwriters who are bringing expert skills to a specific area of insurance or reinsurance. And so in this instance, when we're going back to the beginning of what Bermuda was like, for instance, right? We're also in this day and age seeing what? We're seeing people struggle to form new commercial reinsurers. But if you're an MGA with the expertise, you can bolt on your expertise through your agency agreement to an existing commercial reinsurer or through an ILS platform like Artex and through third-party capital, where you can get to market quicker, you can get it easier, right? And you can focus on exactly what you need to do only, without necessarily all the headaches and system issues you have for other commercial reinsurers. So for me, it really goes back to Ethan's comment of flexibility. It helps being a diversifier for the existing commercial reinsurer, bring an expert MGA onto a platform already in place to write a book of business perhaps you're not experts in. It helps then on the investor side to say, I'm only going to invest in this MGA and the book of business they're writing, so I can pick and choose what I want to write in, which goes back to perhaps why other large commercial reinsurers are not being formed today. It allows you to do speed to market. So it's almost like the ILS market here with the expertise of the MGA is almost like a perfect scenario, right? It gives us new expertise, gives us diversification, it gives us additional capital, and for the platform that's being used, if it's a commercial reinsurer hiring an MGA, it gives them diversification also. And if it's not through a commercial reinsurance, through a platform like Artex, it allows the ILS player to come into the market without necessarily having to worry about all the systems you have to put in place from day one. So it's really a win-win, whether it's a bespoke transaction or long-term, or from the commercial reinsurer who's going to write the business half of the MGA.
Great, thank you, Brad. That's a really good overview. Now, moving to you, Raoul. You're the panelist representing the investor community for us today, so perhaps you could give us an overview of how Stone Point works with the industry to bring your capital to those innovative arrangements for risk originators.
Absolutely, Steve, and thank you for having me on today. So perhaps just taking a quick step back, a little bit of background on Stone Point. We're a financial services-focused private equity firm. We manage about $35 billion of capital on the private equity side. We also have a private credit arm that manages approximately $10 billion. Some folks may know this, but we have a very, very long history of investing both in and alongside the insurance industry. Really, this sort of harkens back to when we spun out of Marsh & McLennan as their private equity arm, or formerly known as MMC Capital. So very much insurance investors at heart, and insurance in its entirety across the value chain, be it distribution, underwriting, services, tech, is part of our DNA. I would say that's relevant background because it gives us a fairly deep network of relationships across both insurance underwriters or risk originators, and those can, as the purpose of this webinar, can be of different formats, right? They can be traditional carriers, or it can be MGAs, as we're talking about here, as well as a deep pool of LPs and other investors to pull from. So to answer your question, how do we interact with the insurance industry and the insurance value chain? I'd say first and foremost, at the end of the day, given our DNA, we are investors. We are looking to partner with high quality originators of risk. That could be traditional cedents, this could be MGAs, and we're going to be investing our own dollars in these deals. And on the backs of that, we're going to look to our LPs and other investors to raise third-party capital. I'd say secondly, in any ILS deal, and this is somewhat stating the obvious, and it goes to the comments that Brad just made about having a bespoke niche that you are an expert within, it really boils down to the underwriting. No amount of financial engineering, structuring, returns enhancement, subordination, or what have you can remediate poor underwriting. So we're laser focused on finding originators of risk who have a long and stable track record of quality underwriting. And I'd say we're pretty uniquely positioned, just given our broader portfolio of assets encompasses a whole host of distributors, underwriters, MGAs, and the like. So we can often pull from those as well as the third party and broader market to find sources of risk origination that lend themselves to ILS formats. I'd say third, and this again is a little bit of a redundant comment, especially given the high quality investor breed service providers you have on the line today, but structuring these deals in a seamless, painless way for investors is critically important. If you think about a sidecar transaction today, and I've worked with Scott, I've worked with Ethan, and certainly I've considered Brad working with Appleby in the past, and we should get that commercial arrangement in place in the near future. But I've worked with these folks to bring together a whole host of constituents that then come together in what's a seamless value proposition for investor. You're structuring a sidecar deal, you need a front, you need an offshore administrator, you need counsel, onshore and offshore, you need an asset manager to the extent that's being outsourced. All of these parties need to be able to talk together. They need to be synergized in a single value proposition and product, and then you can take to investors. And I think that's important just because that underlines the overall complexity in bringing one of these deals together. And that's where the fourth part of where we interact with the market comes in. We are looking to be educators for our capital partners those of whom are less familiar with insurance risk, be it in the traditional format or in the sidecar format or any ILS format for that matter, there's a big component of us helping them get up the curve. And this is how to think about insurance risk. This is how to think about these really innovative structures and ILS technology that's out in the marketplace today, and how best to sort of capitalize on the pricing dislocations and hardening and softening markets that are prevailing at any one point in time. I'd say lastly, and this sort of harkens back to my comment about us having capabilities on both the private equity and the private credit side, to the extent that the subject business affords us to do this, we would like to bring to bear our asset management capabilities as well. I think we're pretty uniquely positioned, just given our heritage, our DNA, and the fact that we have both private credit and private equity capabilities to really create custom and bespoke portfolios that match the asset liability profiles of the subject business that we're looking to put into one of these vehicles. So that's a summary of how we look to partner with the industry and the various stages that we get involved with it.
Great, thank you, Raoul, and I'm glad you explained so succinctly there how the value chain has come together around this opportunity in the industry, which is really important, having all of the different service providers and expertise to actually deliver a good product to investors and to the originators as well. A quick reminder for our audience, you can submit questions in the Q&A, and we will try to get to as many of those as possible towards the end of the discussion, but please do submit any questions you have. So now we're going to move on and talk about sort of why this trend's developed and what it offers risk originators like MGAs. So a lot of the transactions we've seen publicised look like a sidecar, and the motivations seem similar, but there are finer details around these that are a bit more nuanced perhaps. And I'm going to start with you, Brad, this time. When you engage with a risk origination specialist like an MGA, what is it they are generally trying to achieve, and how do you advise them on the capital markets opportunity?
I apologize. Let's break that into two buckets. Let's do the MGA side of it, and then let's talk about the capital they're going to bring to bear, because I think it's two different structures from my point of view. I think the MGA is saying, Brad, I want to get to market quickly. I'm an expert in a certain line of business. Back to Raoul's comment, it's all about underwriting, right? They know this book of business very well, and they know it backwards. And that's why the investors are choosing them. And that's why the risk taker will also choose them. So it's, for my purposes, for them, it's, what is your experience? Assuming it's going to be in Bermuda, right? What do we have on island to underwrite, to meet with the people, to meet with the BMA, which is going to be very important to the BMA. Is your paper, your platform, the risk taker in Bermuda, right? Because the Bermuda Monetary Authority wants a Bermuda agent to act for agent for another Bermuda company. Sometimes we see them allowing to being agent for non-Bermuda companies, but then we have to go through a process to explain to the BMA why that risk taker has the capability licenses to write this business. The preference is going to be in Bermuda to ensure we don't harm our reputation. All right. Then we want to make sure that indeed you have someone to write that business. It's not just conjecture. Hey, Brad, I'm expert in this type of business. I have no one to write the business for, right? So that's really important. Now, the experts that we found have done it really quite quickly. We've got one right on the go right now, which will be registered in 2 days' time. And it's easy. The BMA will only allow you to be agent for companies that have agreed to you. You have to actually make sure the license says Brad can be agent for, and it's on your license. All right. So that's the angle where you are acting as MGA for an existing commercial reinsurer. If you're going to take the opposite side of it, where the MGA says, and I pick on Scott now, I'm going to be MGA. I'm going to write the business through an existing ILS platform. I'm going to write it through a secret account. I'm going to bring in investors to collateralize that risk through someone else's platform. Then the question there from the BMA will be, are they sophisticated? Are they knowledgeable? What type of investors they are? Back to Raoul's point and Ethan's point about long-term investors. Are they going to be around for the length of the program? Is there any liquidity options at the end or halfway through? things like that to ensure that investor knows what they're doing, knows how illiquid the investment is, and then back to the investment structure collateralizing the risk. Again, back to Raul's comment about how you can invest it. Thinking about, hey, Brad, will the investment portfolio provide enough liquidity for the cedent who's writing the risk? And is that liquidity matching the risk profile that you're underwriting, right? Which is really important if you think about whether it's P&C or the recent trend of a large increase in casualty. Let's call it casualty collateralized vehicles, whether it's a one-off platform, whether it's ongoing formation, or a medium-term vehicle. All those things we're seeing now, and it's a bit of the flavor of the month recently. But that depends now on your investment portfolio and the investor understanding how we're going to invest the collateral supporting that transaction, and the BMA getting comfortable with that investment portfolio.
Great, thank you, Brad. So there's a number of different use cases, obviously, for these structures. But we're going to move back to Raul now, and perhaps you could give us a little more about the investor motivation here. So what is it that attracts Stone Point to this type of arrangement, and how you deeply engage with the risk originators themselves?
Yep. So I think, Steve, you sort of said this, but the fundamental premise is at the end of the day, you want exposure to insurance risk. Motivations might vary. You might want to do it because you want a diversifying or uncorrelated risk in your portfolio, or you're just trying to take advantage of a hardening market or a capacity dislocation. And we've seen both of those in different markets in the prop cat and the casualty side in the last 2 years. I'd say with that in mind, fundamentally back in 01 and 05, when you had the two classes of reinsurers that we're all quite familiar with, you could capitalize a de novo reinsurer or buy one below book value relatively easily given pricing and terms and asset returns. You could generate a 20% ROE and then sell our IPO for somewhere between 1 and 1.5 times. That is a relatively straightforward way to generate a 20% IRR. In my mind, and from where I sit at Stone Point, that same opportunity does not exist today. There hasn't been a class of 22 and 23, even though pricing conditions in various parts of the market have been very attractive. And I fundamentally think that's primarily driven by the fact that it's actually pretty hard to accrete book value at 20% per year on a recurring basis and generate an exit that's going to be attractive enough to get you that 20% IRR. You guys have all alluded to this, the proliferation of ILS, the efficiency of the market today, and the technology that's come to bear. I'd argue that that's a much more efficient and higher return way to tackle and take insurance risk today. As an investor today, if I have a view on pricing or demand within a specific subsegment of the market, or I just want a broad and diversified portfolio of risk, the format that I'm likely going to leverage, and we've done so thrice this year already, often with folks on this call, is to collateralize a collateralized insurer, likely in Bermuda, Brad, and then place that behind the front. It's a pretty capital efficient way. It allows me to lever my upside by ceding the tail, whether that's the front providing that leverage or I'm going to third-party reinsurance capacity. And then based on the business mix, and this was the part I was alluding to earlier about managing asset liability profiles, and Brad, you hit the nail on the head with this as well. If I can pair that with a relatively attractive asset strategy, I can really deliver a pretty attractive IRR, and often with a price and date certain exit mechanism, bringing to bear a third-party provider such as an Enstar or another legacy runoff provider. So fundamentally, that's the draw for Stone Point. We can be nimble, we can be opportunistic about risk selection. At the same time, we can leverage what, in my mind, is a highly capital-efficient structure like a sidecar to invest in the insurance space. To answer the second part of your question about how do we engage with the risk originators and underwriters, and you'll probably hear me beat a dead horse here a little bit, a couple of times, but the most important thing, once again, is underwriting and track record. With that in mind, we engage very, very deeply with the originators of these risks. We want to know the folks that we are looking to partner with on a sustainable, recurring basis. Ideally, we want our investors to think about these partnerships on a longer term basis and ideally have these vehicles be serial issuers returning to market. And it's quasi permanent capacity, right? Because it is not a platform investment or a platform that's intended to be sort of a stock company. But that said, we want this to be a recurring theme in the market and not a one-off sort of transaction. And with that in mind, so I'd say, we're looking to build really sustainable relationships in both the risk originator and the investor side.
Great, thank you, Raoul. You explained well how compelling this can be as well there, which was great. So, Scott, moving on to you, perhaps you could give our audience a bit of insight into the types of use cases that risk originators and MGAs come to you with at Artex, and also how you ensure the right structures are selected to benefit the sponsors and ensure investor needs are also being met.
Yeah, sure. Thanks, Steve. Yeah, a very broad. The short answer to that is a very broad market subset is interested in this. So to give specific cases, one end of the spectrum, we see parametric MGA type portfolios looking at these types of structures, right through the insurance segment space to liability covers. Now, the trick with all of this is to how to structure it and how to back to Raoul's point on the bringing it together and using the correct structure within either Bermuda or Cayman. I know a lot of people have been talking about Bermuda today, but we're also seeing a lot of activity in Cayman as a jurisdiction. So effectively, obviously at the parametric end of the spectrum, that is a very clean, liquid and transparent market, and the benefits that come with that are quite appealing for a number of investors. Right through the value chain to, like I said, to the liability classes where potentially the investors want to actively manage those collateral assets. So we're seeing a whole host of different structures and being able to apply, but like I said, those tried and tested structures against or on top of these MGA portfolios is what we're seeing right now.
Great, thank you, Scott. And it sounds like the motivation comes from both sides of these deals, as well as with Raoul explaining the investor appetite there, and you giving us some overview of how the MGAs look at these things. So moving on to Ethan, more broadly, perhaps you could share some of your experience of working with the MGA community. What type of problems are they coming to you with? And do you see a growing opportunity for companies like MS Transverse to act as an intermediating market to help in accessing efficient capital sources?
Yeah, I'll take the first part of that question first, and it really boils down to two themes typically when the MGA is driving their conversation about potentially accessing alternative capital. The first is just the availability and stability of capital to support their program. Shifting reinsurer appetites can sometimes mean disruption for an MGA. So they're really looking for ways of diversifying their portfolio with partners that are in it for the long term. And not to imply that traditional reinsurers aren't. There are a host of different appetites out there, but having additional access to other markets certainly is a benefit. The second recurring theme that we see is looking for an ability to participate in the underwriting income. And I thought Raoul summarized it really nicely, either because of diversification or because of the expected returns, in a way that allows them to harvest some additional profit from the underwriting results of what they're doing, not just the volume of what they produce, but also in a way that can limit their downside risk and prevent them from being revalued as an insurance company. That's a big concern for a lot of MGAs, is that as they think about starting to take risk, and when I say they, it could be the management of the MGA investing their personal funds, or it could be the ownership of the MGA investing other sources of capital. But there's a real concern about wanting to be able to have the benefit of the underwriting income, but without the downside of a change in the way they're looked at from a potential investor or acquirer. So what does the fronting company do, in this? How does MS Transverse address this? And what's interesting, and if folks have worked with us, you may know, the whole name of our company, Transverse, was chosen specifically to illustrate our mission, which is to connect, to transverse the gap between the MGAs that are writing the business and the capital providers, be they traditional reinsurers or alternative capital providers, that are interested in supporting the business being written. So from the very get-go of our origination, we were thinking about this. We have a team of 5 people whose full-time job is only to source, evaluate, and build relationships with capital markets, be they private equity or be they larger companies, many names that you would have heard of, but we can't disclose. Raul mentioned we are partners today, MS Transverse and Stone Point, on deals in the MGA space. That's a very successful partnership that we're very excited to be able to share with people that are aware of it. But facilitating access to capital is really one of the key things that we bring to the table and a fronting company can bring, because we help connect those MGAs with diverse ranges of capital providers. Obviously, if their owners are interested, they are already aware of that and bring the capital provider with them. But we can help introduce them both to traditional reinsurance markets, ILS funds, and other alternative capital sources. And the ability to evaluate these sources, I think, was highlighted when last year we had a very public blow up of an alternative source reinsurer where there were allegations of fraud and other things. But ultimately, the ability not only to source these capital providers, but to evaluate them and make sure that there's legitimacy behind what they're offering and the way it's being done is something that the fronting company can bring as a service in that transaction. We can help guide the transaction. Our experience with these deals, we've seen a lot of different ways they get carved up. Some people like to take cat risk. Some people don't want any cat risk. Some people want the additional returns from a highly volatile long tail line of business. Some people want a more stable get out quick investment. And so understanding how, and it's not just specific to a line of business, because there are ways to structure these deals for almost any line of business that can accomplish the investment objectives of the people that are bringing the capital to the transaction. Lastly, there is a fair amount of regulatory expertise, and in no small part, partnering with people like Brad and Scott, we've been able to build a network both within our own expertise and those third-party partnerships that we have to really help people understand through this team effort what are the requirements that are necessary, what are the legal agreements that are needed, what are the regulatory requirements that need to be satisfied. So all these things need to be part of the conversation to be able to be sure that you have an effective transaction that can persist and provide the benefits that they're looking for. I will say that the increasing complexity of the insurance market, coupled with the growing demand for these specialized risk solutions, it's really driving the need for more efficient and innovative capital solutions. So we're very well positioned to capitalize on this opportunity by providing that seamless bridge, that transverse, if you will, between the MGAs and the capital providers.
Great, thank you, Ethan. Yeah, I think this is a really interesting development, and there's a lot of work that's gone into getting us to this stage. So I think let's try and dive a little deeper into some of the technicalities of entering into an arrangement like this. And Scott, I'm going to start with you this time. It'd be good to hear how you prepare a risk originator such as an MGA when you're getting engaged on a transaction or an arrangement like this. Sort of operationally, what do they need to be prepared for? And structurally, what are you helping them to be aware of to make these things run smoothly for them?
Yeah, certainly. This really depends on where the MGA is in their life cycle. Startup MGAs probably are more looking at a captive style structure with potentially one eye on the future for introducing third-party capital. For those types of startup entrants, we're truly looking at jurisdictional type issues, regulatory type issues, and trying to advise them on their best near-term and long-term solution. For more mature, long and stable type MGAs, where potentially third-party investors are more interested in having conversations with them, that's where we're really honing what you'd call a traditional sidecar model. So effectively, they come to us, and we have these conversations around the fronting relationship, what their investor appetite is, and what type of data that they house. So transparency of data is critically important at this stage, and making sure that they have a really good handle of their data, as does the fronting company. Having it in a sort of a consumable format for the investor community is critically important. If they can't communicate their underwriting thesis and results adequately, then the conversation typically stops pretty quickly. The other really critical point is not only on the entry, is the exit. Investor exit points are critical. We've seen lots of different innovative structures recently, specifically around liability covers and prescribed optionality exit points, which are really interesting. This gives investors certainty about their exit points and some of their IRR modeling. This is critically important and something that's been brought to market just recently.
Great, thank you, Scott. Yeah, I think you're right there. The exit arrangements that we're beginning to see are really critical, and they kind of finish off the value chain here a little bit for the longer-tailed structures. So that's a really positive development that we'll definitely see more of. Raoul, moving back to you, it'd be great to hear what Stone Point is looking for from partners when you enter into these arrangements, and perhaps you could touch on that level of data transparency that Scott mentioned, and what sort of preparation and due diligence you're requiring from people. And I guess also maybe what you need to see that provides you with the comfort that you're selecting the right partner. You've mentioned underwriting performance, but how do you get comfortable with that?
Yep, absolutely, Stephen. You beat me to the punch because at the end of the day, underwriting is first and foremost. It is the number one determinant for us in deciding to partner with a risk originator, the quality and the longevity of underwriting, right? I sort of just put a finer point on that because as some folks may know, we've done 3 deals in about the last year and a half. Our counterparties in those deals were names that most folks would recognize. So Axis, everyone knows Axis. Starwind, which is the casualty lines MGA that's part of Truist Insurance Holdings, really scaled MGA platform, writing over $3 billion of premium in the aggregate. And then, of course, AmRisk for our property cat deal, which is the largest property cat MGA in the US, if not the world. And I'd say common thread, the commonality across all of these counterparties was the fact that they are established blue chip underwriters with long track records of successful underwriting across market cycles. And that last piece is quite relevant, especially as you think about longer tail lines of business. I'd say secondly, in terms of what we're looking for in one of these arrangements, we are looking for alignment. I saw one of the questions that was asked around, do these structures generally lend themselves more to a quota share or an XOL type of transaction? For us, the most attractive format is going to be a whole client quota share, where we know there's absolutely no possibility for adverse selection or cherry picking of programs and the like. And the other way to sort of drive that alignment is through risk participation. I think a couple of folks on this panel are alluding to the fact that these structures allow management teams, allow other stakeholders to invest their own dollars while not necessarily diluting their enterprise value multiple by getting a book value valuation versus a fee income multiple. And that is critically important to us. We want to retain that valuation paradigm, but at the same time, we want true alignment and skin in the game. Your question around how do you prep for one of these deals? And again, I saw one of the questions in the comment section was around time to market and what have you. And while these structures are much more efficient in getting to market quickly, the amount of time that is required can vary based on the complexity of the subject portfolio, the number of different stakeholders you need to bring to bear, and sort of just the complexity of the transaction and how new it is. But to really hit on some of the salient points, I would say data quality is of paramount importance to us. If you think about all of my comments about the quality and the longevity of the underwriting, what we're looking for is multiple years, ideally across cycles, but I appreciate that isn't always possible, but multiple years of clean underwriting data. That is, as we think about the funnel for subject business into a vehicle, that is probably the number one determinant of if anything gets kicked out. It's still a whole kind of quota share concept, but data quality needs to be very, very high, and data fidelity and our ability to diligence those historical numbers is it's a foregone conclusion. It needs to be there, and we need to be able to do it. And it's important for our co-investors as well. I think, there's an interesting dialogue here around there's different formats if you're partnering with a newer MGA and there's a captive, and you leverage the captive format to sort of stand one of those up. For us, the existence of existing capacity providers is an important hallmark of folks we look to partner with. Said differently, we're looking to partner with MGAs that for whom a sidecar or an alternative capacity vehicle isn't a market of last or first resort. It is because they're looking to diversify their sources of capacity. It's because they're looking to expand that capacity pool and really enter the capital markets and deliver a unique insurance product. We're generally not looking to partner with MGAs that are still in the process of building that existing capacity panel, which is not to say they aren't phenomenal underwriters, but just a different part of their life cycle for us to get involved. I'd say as you think about deliverables for both us and our co-investors, a flexible but succinct and easy to track model is critically important. I think all of our investors want to be able to flex underwriting assumptions, especially as you look, at longer tail lines of business, reinsurance buying assumptions and the like. Just having a cohesive, easy to track model is very, very important. And I'd say lastly, and I'd be remiss not to say this with my fellow panelists on the line here, high quality service providers. That is critical to any deal. If I am worried about, trust documents or my front understanding how reserving should work, how trapped capital and buffer factors need to be applied, those are the wrong dialogues to be having. You want folks that have done this time and again. They are experts. They just make your life easier. They make your investors' life easier, and you're able to bring them all to bear in a very seamless single offering that you can then deliver to the market.
Brilliant. Thank you, Raoul. You're selling the service providers very well there as well.
I'm hoping for a discount on the back end, guys.
Absolutely. Ethan, going to move on to you, and perhaps you could speak a little more about the role of the fronter within these arrangements, and also any considerations that you feel MGAs need to be preparing for to go down this sort of path.
Yeah, there are three things that the fronting company really plays a critical role in these types of transactions. So one is regulatory compliance and licensing. So there needs to be the appropriate licensing for the insurance entity to be able to be the source of the business that the MGA is going to place on their paper. And that includes all of the necessary licenses across the various jurisdictions, compliance with local laws and regulations, et cetera. But I'll also put in here, the comment around solvency. I will jokingly, at least in part, often say there's no such thing as a fronted program unless you show me a one-page reinsurance contract that says you give us all the premium, we pay all the losses, no questions asked. There's not a single reinsurance contract I've ever seen that's worded that way. So there's always residual risk that exists within the carrier, and you want to make sure that your carrier partner has the expertise and the technical know-how to understand what risk it is that they are retaining that isn't getting passed through, and that they have the financial stability and backing to be able to afford any of those risks should they come to fruition, right? So understanding those key items, you want the longevity, you want your partner to be around for the long term. That includes all the partners in the transaction. The second thing is risk underwriting and management. So it was mentioned, for Raoul at Stone Point and for many of the capital providers that we talked to, having confidence that the portfolio will produce the underwriting returns that they're looking for is a key part of any successful transaction. So looking at your possible fronting company partner's track record in overseeing, selecting, and managing MGA portfolios, what has the track record been in terms of profitability? What has the track record been in terms of longevity? Are they flipping MGA partnerships, or are they bringing partners on who are over a reasonable time horizon producing an appropriate return? Overseeing claims is a key piece of that. So what capabilities does your partner have to make sure that the claim process is being managed appropriately, both from a claims handling and a claims reserving perspective, because problems in either of those areas can really erode both the economics and the trust involved in those kinds of relationships. And I mentioned before, interfacing with capital markets is so important. Does your carrier partner bring an investment team that builds relationship with institutional investors, pension funds, other capital providers to help attract and retain capital for risk transfer? Do they have the necessary expertise to work with structuring agents and legal counsel to help design these innovative risk transfer structures? And are they actually doing due diligence on those partners? Are they just happy that someone shows up with a briefcase full of money, or are they poking and prodding at what form does that funding take? Where's the ultimate source of those funds? Is it stable? Is it legal? Does it meet all the regulatory requirements and all the prudent risk management type requirements? So those are the things that we bring, and I would say for an MGA, there's a couple things that they really need to consider. So first, do they understand regulatory and accounting implications that would happen as a result of having one of these transactions, in particular if they are looking to be one of the investors behind the transaction? Do they have the robust underwriting processes to select and price risks that are attractive to capital providers? Have they invested in data and analytics capabilities? Can they produce the information on a timely and consistent basis with accuracy and completeness that will satisfy the reporting requirements that an investor would want to see surrounding these types of transactions, which often is a bit more than what is just necessary to satisfy regulatory financial accounting requirements? Do they have relationships, or can they work with a partner that can help build those relationships? Most times the capital provider wants to know who the MGA is. They don't want just a random assortment of names that they've not seen before on their investment sheet, but they'd like to actually know the people and have heard of the people and know the reputation and the history of the group that's there. Does the MGA have their own financial backing to be able to operationally support the business that they're producing for these things? What's the funding look like? There were a lot of insurtechs that came into the industry in the last decade, and some of them had great ideas, but a very short runway. And short runways of capital to support the business they're writing can lead to inappropriate behavior or an untimely exit from what otherwise looked like a very good business model. And lastly, do they have good risk management practices at the MGA? Can they weather things like a global pandemic that forces the entire staff to not be able to come in the office and work remotely? Can they do that seamlessly without disruption to their customers, without risking things like having a cyber event that would compromise customer data or would otherwise shut down their operations for a time? So MGAs really need to think about these different things, and we can help, as well as the other partners on this call can really help them sit down and kind of walk through, is this the right type of thing for me to be considering based on where I'm at, or what types of expertise or resources would I need to acquire or build to really make myself a more attractive partner for one of these types of transactions?
Thanks, Ethan. That's a really fantastic checklist of what an MGA really needs to think about before entering into these sorts of arrangements or considering doing so. Moving on to you, Brad. It'd be great to get your views on the importance of regulatory compliance and also what a risk originator needs to be considering in choosing a domicile and a structure for an arrangement like this.
That's really easy because, I am completely biased on this topic. I think everything should be in Bermuda, so I admit my sins now, even though Scott mentioned another jurisdiction by accident, I know. But I'm going to go back to one of the comments that Ethan made and tie to a recent trend, which is casualty, obviously, sidecars, or casualty ILS, whatever word you like to use. I think all the points that Ethan mentioned are really important, but even more important for this long tail specialty risk, casualty risk, which is not like your typical cat risk, which might be gone in a year. It might take 5 years, 8 years, or longer to go through the system. So when you think about liquidity of your investment policy, or your investment matching that Raul mentioned, or your KYC on the top of investor you might be, or the MJ having the capability to be around long enough to manage these risks, all those points that Ethan mentioned are even more important and come to the front if you're doing a casualty sidecar, right? Or a casualty platform. And that's what you're really hearing these days. You're hearing more, you are still hearing about the traditional sidecars, but almost everything you read these days is the rumors about casualty sidecars, right? And so when it comes to regulatory point of view, all regulators and insurance managers, auditors, investors, lawyers really have to emphasize even more these issues. And the BMA should have more oversight on these topics because more can go wrong over a period of time than a 1 year quota share of a P&C, cat risk program, right? And so I think that means that when you do it, the classification of insurer goes up in Bermuda from an SPI to a CI. And the robustness of your policies, we call it, and who's involved has to be of a higher standard. has to be of a higher standard. And there has to be more cohesion, as I think Raul said, between all the service providers and the parties to the transaction to ensure we know what we're investing in, we know how long it's going to take to run off, and we know what we're going to look like in 5, 6, 8 years' time. And can you actually manage the risk, or are you going to damage your reputation? I mean, 4 years later, be thinking, I can't really pay my bills anymore. I have another issue, right? Which comes back to Ethan's comment about making the wrong decisions because you're running out of cash, right? So I think the latest trend is exciting. I think you're going to see numerous of casualty sidecars being formed, or casualty transactions, permanent and non-permanent, to be clear. I think you're going to see people using platforms and people forming their own platforms. But I think this topic is really going to be important for the BMA. On jurisdictions, the king of ILS is Bermuda, has been the king of, has been the number one jurisdiction for all ILS for years, continues to be. We have to make sure we stay front and center and keep on doing our job properly, whether it's the BMA, service providers. So I think in this end of the day, it becomes easier if you do it in Bermuda, only because you've got the investors, you've got the front, you've got the platform, you've got the regulator. There's so much here, it becomes a one-stop shop. So I think that becomes a lot easier for someone to handle. And to be honest, you can do deals with your counterparties really easy because you're probably doing a deal with another player who's in Bermuda also, right? It's a real marketplace, right?
Yeah.
So I think that makes a difference also. And I think it makes a difference to someone like an Ethan who knows that if he's doing a transaction with a Bermuda carrier, already automatically knows there's a sophistication going along with that automatically, knowing full well there'll be staff in Bermuda, people in Bermuda, independent directors in Bermuda. So I think it gives everyone a bit more comfort because all the little touch points are all there naturally. That's a natural assumption. You've got to check it, but still a natural assumption.
Great. Thank you, Brad. Yeah, and really important to also note that this is a learning experience for regulators as well, I suppose, with some of these structures because they are still pretty new. So we're coming up to literally only 7 minutes to go in our session, and we still had a whole round of questions to go. So I'm going to shorten those questions a little bit as we've actually covered off a lot of what the final round was going to explore. I'm going to start with Scott this time. So how do you see this opportunity at Artex for the MGA community, and is it something that you expect is going to become increasingly sophisticated over time?
Yeah, definitely. And just to keep it really short for you, Steve, definitely. I think the optimal word today has been track record on the underwriting side, and also from the vendors that put these structures together. Having a really strong track record is key to being able to provide effective solutions in the near and longer term, as Brad sort of alluded to. So yeah, here at Artex, we're open for business and really excited for the future of this market. And I've said it before, but a lot of these structures aren't fundamentally new. We're just overlaying tried and tested structures on different risk classes and different ways that risk originators are bringing insurance risk to the capital market.
Great, thank you, Scott. And Ethan, moving to you. I mean, you mentioned that MS Transverse, the name speaks to connecting risk and capital and branching across the different forms of capital as well. But how big an opportunity do you feel the capital markets can be for these MGAs?
I think it's huge. There's a significant opportunity for MGAs to access diverse sources of capital, whether that's institutional investors, pension funds, hedge funds, or other sources. And by understanding the expectations of companies like MS Transverse and the requirements of capital markets like Stone Point, MGAs can really position themselves to take advantage of these opportunities to help achieve long-term growth and success.
Great, thank you, Ethan. And Brad, moving to you. I mean, I've known you for a long time. I know you know everybody in the industry pretty much. So what are you hearing from people about their appetite for these sorts of transactions, I guess, both on the sort of cedent or sponsor side and on the investors you speak with?
I think it's only an upward trajectory. I think we're really seeing a real interest. Let's break it into three different things. MGAs, no question more MGAs are coming before year end, all right? So there's an increase of that from a lot of the reasons we talked about. there's a total increase in casualty sidecars, and people talking about casualty programs within existing platforms. So you might not read about them, but also casualty sidecars as standalone platforms. So there's no question, if you could look into the platforms like a Scott's platform and stuff like that, Artex, and ask them how many more casualty programs did he do, which is not public information, I appreciate. I think it's more this year than last year, as I would argue. He's thinking about it now, you can see him, but it's definitely on my side more. And then on the investor side, we are not hearing our clients saying to us, Brad, I'm struggling to find investors to write this business. Right? It's more the opposite. The investors are looking to write the business for lots of the reasons that Raul mentioned earlier. There's more investors in ILS. People are more comfortable with casualty than we were before. So I think it's all rising together, actually. Now, the issue is going to be for the investor is not everyone is the same, right? He's trying to work out, back to Raul's comment now, which underwriters are the right underwriters, right? But I think you're going to see an increase across the board at all levels. And the question is, who's a better underwriter? So I'm extremely positive about this. I'd be interested if you look back in 9 months' time and see what the market did. I'm sure there'll be some pretty interesting numbers.
Great, thank you, Brad. Yeah, I think what Raoul said earlier about the appetite to access these structures in an efficient way being something that's very attractive for investors is a key development we're seeing now. And moving to you, Raoul, perhaps you could give us your broad outlook for this trend we've been discussing and where you see it going from here.
Yeah, absolutely. So I think everything you've heard in this call is what I would sort of echo my sentiments on, in that the proliferation of ILS and the proliferation of taking insurance underwriting risk through these new alternative capital structures, including sidecars, cat bonds, and the like, is just going to continue. The technology is improving. The service providers only get better. The finality and the ability to structure defined exit mechanisms and price certain mechanisms is critically important, because that gives folks a defined investment horizon. So broadly speaking, those factors, coupled with the fact that the growth in MGAs, the growth in E&S, the growth in the fronting market have all grown at, nigh 20% CAGRs over the last 5 to 10 years, are going to continue driving a ton of growth in this part of the market. I'd say the one other broad observation I would leave folks with is, I think there's a blurring of lines today between risk origination and distribution. If you think about the large wholesalers today, you think about Amwins, Ryans, and of course TIH, all of them derive a substantial portion of their revenue from their program and binding operations. So that, in my mind, the ability to source both the risk origination capacity and having a view on who the underlying insureds are desiring those types of coverages is critically important. You're sitting at the nexus of what is effectively where you ought to be designing these new products, and often the way to incubate them is through both MGAs and on the back end through these sidecar and other structures that we've been talking about today. So I think that line is going to continue to blur, and if you will, the vertical integration and the horizontal integration of the insurance value chain is going to continue to permeate over time.
Great, thank you, Raoul. So we have about time for maybe one question, maybe two questions from the audience as we run up against it today. But we've got a good one here, which may be a bit technical, but somebody should be able to add some value on this. So what is the expected minimum annual premium required for this type of capital market structure to function effectively? And what are the fixed and variable cost elements included in the transaction that people need to be thinking of? Anybody got a point of view on that?
I mean, I can take a stab at it from our perspective. I'd say, if we're talking about annual premium, it really depends on the level to which you need to collateralize the vehicle to, right? I mean, if you're collateralizing that let's say it's 100 million in premium. If you're collateralizing to the 1 in 1,000, that certainly deems the required amount of collateral being a lot higher than the 1 in 100, right? Just stating the obvious. In my mind, I would like to think that somewhere in the $75 to $100 million premium range likely makes sense, just as you think about having a relatively diversified pool of investors. And then in terms of the fixed costs, you can think about those as if it's a fronted vehicle, there's going to be a fronting fee. There's going to be FET depending on where you domicile. There's going to be obviously losses and expenses, but that is part of the underwriting. If there's an asset management strategy associated with it, there's going to be a defined asset management fee or an IMA fee associated with that as well. And then to the extent you want a price and date certain mechanism that is not a recapture or just sort of a cutoff provided by the fronting carrier, if you're looking to bring to work someone like an NSTAR or a Premia or what have you, you're likely needing to bake into your modeling the risk premium that they're going to charge you at the exit to effectuate that novation or commutation.
Great, thank you, Raoul. And there's one other question that we can maybe tick off pretty quickly. And again, it's actually directed to you, Raoul. What mechanisms have you seen in these structures that give you comfort that the interests of the MGA are aligned with your own? Anything around sort of profit commissions and sliding scales or anything like that?
So I'd say that's a great mechanism that helps, but that already exists, right? Having sort of the ability to slide both up and down in the PC certainly helps. I would say more important for us though is risk participation. So in the deals that we've looked to do, especially if you think about what we did with Starwood, one of the big reasons we brought that deal to market is because the underlying program managers wanted to eat their own cooking. They wanted that exposure. And from our perspective, an investor's perspective, that just drove tremendous alignment. So I think having that element probably gives me more comfort than anything else, in that there's alignment, and we being investors are not solely a source of capacity, which then drives premium, which generates fee income.
Great, thank you, Raoul. Okay, I'm going to wrap things up now because we have run over time, and I know that some of our panelists have to get on to their meetings and continue their day. As you might be able to see, it's getting towards the evening here. I've been having to switch lights on as we go. But I just want to say an enormous thank you to Scott, Raoul, Brad, and Ethan. I think you shared some fantastic insights there. There's some really good technical advice for people who might be considering these sorts of arrangements, either from the originator MGA side or from the investor side. So I really appreciate you sharing some time with us today. Thank you all. For those who are attending, thank you for watching. There will be a replay available. You'll get an email about that, so you'll be able to watch this back in case you missed any of it. And we'll keep you posted of any future Artemis webinars as well. So thanks again to our panelists. Really appreciate your time today.
Thank you, Steve. Really appreciate it.
Thank you, Steve. See you all.
Take care.
Take care.